The year is 2014, and Adidas is struggling. The once dominant sportswear company is now lost and directionless, having suffered through declining revenue and profits for 3 years in a row. Outside of football, consumers don't seem to care for the brand, retailers are giving up their most valuable shelf space to Nike, Adidas's new products are flopping, and activists are threatening a hostile takeover if the CEO isn't replaced within the year. In this episode, we'll cover Adidas, the fatal mistakes that its former CEO made, which toppled the German brand to a distant third behind Nike and Under Armour, sparked an investor battle, and ultimately cost him his job. We'll also cover the winning strategy that revolutionized Adidas and the new CEO's moves, which have since then taken the company to new heights. While the average CEO tenure is 5 years, Adidas has only had 2 CEOs in its modern history, Herbert Hainer and Kasper Rorsted. Our story starts in 2005, the early Herbert Hainer era. Hainer was a company man who rose up the sales ranks at Adidas for 15 years before being appointed CEO in 2001. After 4 quiet years at the helm, Hainer made his first big move, acquiring Reebok for $3.8 billion in 2005. Adidas had made its name in Europe as a leading sports performance brand. European football is a true global sport, and Adidas was the leader for all things soccer. For decades, Adidas had been the official partner of FIFA and UEFA. In 2005, Adidas was a sponsor for renowned national football teams like Germany, France, Spain, Argentina, Japan, and prestigious clubs like Liverpool, Chelsea, and Real Madrid. The company was also the sponsor for world-class players like David Beckham and Lionel Messi. Everything from the ball to the kits to the boots had been made by Adidas for over 50 years. For players and fans, Adidas and football were synonymous. While soccer is the main sport in Europe, Africa, and Latin America, it's never enjoyed the same dominant popularity in America and Asia. As a result, Adidas had strong market share in Europe, but small presence in the US and China. Hainer believed that Adidas had reached its limit as a European brand and couldn't be stretched beyond its football roots. By acquiring Reebok, Hainer believed that he had finally found the missing piece for Adidas to become a global company. As an American brand, Reebok would complement Adidas's European dominance by bringing in the high-value Chinese and American markets that had eluded the company for decades. Hainer was so bullish on Reebok that he paid a 34% premium, an additional $1.3 billion on top of Reebok's market cap, to acquire the American brand. Adidas's market cap at the time was only $7 billion. When companies talk about M&A, they're usually referring to small additions or equal mergers. For Adidas to buy Reebok for over half of its own market cap at $3.8 billion is extraordinary. With so much capital spent in one move, Hainer presented a 5-year multi-brand strategy to investors in 2005. His pitch was that sure, buying Reebok cost them a lot of money, but this bold multi-brand strategy would turn Adidas from a humble German business into a global powerhouse. Hainer believed that the company's future success would be less about making clothes and shoes and more about managing brands. Adidas and Reebok were just 2 brands in what over time could become a sprawling portfolio. In his mind, each brand had its own market and demographic. Let Adidas swim in its own lane, let Reebok focus on its own strengths, and over time you could have something for everyone. With this 5-year multi-brand strategy, Hainer promised investors high single-digit growth and double-digit operating margins by 2010. He broke down his strategy into 3 strategic priorities for the company to execute towards. The first priority was to leverage Reebok's strong presence and existing partnerships in American sports to grow sales in North America. At the time, Reebok was the exclusive uniform and apparel supplier for the NFL, the NBA, the MLB, and NHL. Keeping to his multi-brand strategy, Hainer kept Reebok as the brand for American football, baseball, and hockey. Yet he opted for an aggressive approach with basketball, immediately tearing up Reebok's existing contract and signing a new exclusive 11-year NBA deal for Adidas for $400 million. While Hainer left American football, baseball, and hockey to Reebok, he entrusted basketball to Adidas. Basketball was the most popular sport in Asia, and star players like Yao Ming had captured the attention of over 80 million Chinese fans in the 2000s. To Hainer, basketball was critical to winning Asia, and Reebok's former leaders had failed to tap into the sport's true commercial potential. If Adidas could become the leading basketball brand and leading soccer brand in the world, it would have a moat that Nike could never cross. Hainer trusted Adidas over Reebok to handle basketball, and Adidas already had proven distribution networks in China. Through Reebok, Adidas had gained 4 direct channels into the American and Chinese market. Hainer's second priority was to maintain the company's core strengths. Adidas needed to keep its lead in European football. The 2006 World Cup, which took place in their home court Germany, further reinforced Adidas as a leader in all things soccer. Adidas had been the dominant brand for the entire tournament. Nearly every player was wearing Adidas boots, kicking an Adidas ball, and the runner-up France and infamous Zidane headbutt moment were all flashing Adidas kits. While sponsorships and publicity helped generate consumer desirability, the reality was that professional athletes genuinely loved wearing Adidas. The company had to maintain its claim to fame by building the best gear for professional players in nearly every sport. Those product sales made up 70% of the company's revenue every year. There wasn't much more that Adidas had to do but to keep the foot on the gas pedal. Hainer's third priority in his 5-year multi-brand strategy was to win the emerging markets. Beyond European football, he believed running to be the next global sport. Hainer wanted Adidas to become the leading running brand for runners of all levels. The key elements for this strategy had been in place for a while as the company was already the sponsor for the London, Berlin, and Boston Marathon. From a sales standpoint, Hainer designated Russia and Italy as the two strategic emerging markets to win. He was committed to strengthening Adidas' European market share to keep Nike out. While wholesale made up 85% and retail accounted for 15% of Adidas' sales in 2006, Hainer wanted retail to be a bigger piece of the pie. The company was reliant on third-party retailers like Foot Locker to move their product. Hainer's belief was that opening more stores and selling directly to customers would generate higher margins and stronger brand desirability with better in-store experiences. Before the Reebok acquisition in 2005, Adidas' revenue hovered at around the €6 billion mark for several years. In 2006, the first year of Hainer's multi-brand strategy, Adidas broke the €10 billion mark in overall revenue thanks to Reebok's contribution. But beyond the expected top-line boost, the company didn't have much to report and investors didn't have too many questions. They understood that integrating Reebok into Adidas and aligning internal teams to this new strategy would take time. The multi-brand strategy started to take shape in its second year, but the ride was bumpy. Instead of the high single-digit growth that Hainer had promised, the company's overall net sales only grew 2% in 2007. On a per-brand basis, Adidas sales were up 7%, while Reebok sales were down 5%. Hainer highlighted the positives to investors and showed that combining both brands had netted the company an unrivaled network of league partnerships and sponsored athletes around the world. But Hainer couldn't hide from the elephant in the room. Despite the NFL, MLB, and NHL partnerships, Reebok's products just weren't selling. If anything, the brand seemed to be getting less desirable. Hainer's explanation was that Reebok had lacked focus long before the acquisition, and cleaning up the brand had taken longer than expected. To capture just how much of a mess Reebok had been in, he showed off a diagram detailing the before and after makeover that the brand had been going through for the past 2 years. Reebok's appeal in business had been declining for years to the point that retailers were regularly relying on heavy discounts to sell Reebok products. As a result, Reebok cultivated this long-running reputation amongst retailers as an aging brand that sold best when positioned as a value purchase at outlet malls rather than a full-price premium purchase. Discount shoes and clothes are not Adidas' forte, nor was it what Hainer had in mind when he purchased Reebok. Under Reebok's prior leadership, the company had never prioritized selling branded merchandise to hockey, football, and baseball fans beyond the usual athlete jerseys, which left billions of dollars on the table. But most damning of all was that Reebok today had no understanding of who its customer was. Was it a lifestyle brand for outlet moms or NFL fans? Reebok's leaders had no answers for themselves or for Adidas. The entire situation is curious. If Hainer knew Reebok was such an unfocused, mismanaged brand who had lost sight of its target customer, why did he buy the business at such a premium? How were these problems not uncovered during due diligence? But Hainer could never publicly say such things. If he did, he would only be revealing his own incompetence. The deal was done and there was no going back. But as any self-preserving CEO would, Hainer cast a positive spin. Reebok needed to be reinvented, he told investors. Reebok could tap into Adidas' proven resources to accelerate its repositioning and rebuild its credibility quickly. Reebok would get a new logo and return to its roots as an everyday fitness brand. This was a very different Reebok than what Hainer had presented in his grand 5-year multi-brand strategy just a year ago. But if anyone could turn around Reebok, Hainer stressed, it would be Adidas. Impossible is nothing. In 2008, the following year, it appeared Adidas had truly lived up to its iconic slogan. Overall net sales grew 5%, closer to the high single-digit growth that Hainer had promised. Operating margin improved to 10%, and net income increased by 16%. This success was primarily driven by the successful Beijing Olympics and the Euro 2008, for which Adidas was the main sponsor. Backed by solid results, Hainer's message to shareholders was simple: stick to the game plan. Then in 2009, the recession hit, tanking the global economy and blowing up Adidas's momentum. Sales dropped 4% and operating margin plummeted to 5% as the company found itself saddled with too much inventory and debt. To generate cash flow, Adidas aggressively chewed into its profits, issuing generous discounts and subsidies to retailers in order to clear their stock. To make matters worse, Hainer's 5-year bet on winning the Russian market also backfired. The Russian ruble depreciated significantly relative to other currencies during the recession, reducing Adidas's profits that year by over 200 million euros. Despite the economic conditions, there were some wins for Hainer's multi-brand strategy that year. When Ballon d'Or winner and Barcelona legend Messi scored in the Champions League final, he took off his Adidas F50 boot and kissed it in front of millions of fans. When MVP receiver San Antonio Holmes caught the game-winning touchdown in Super Bowl 43, he wore Reebok Kryptonite gloves. When Korean golfer Yang Eun-yang upset Tiger Woods in the PGA Championship, he was using Adidas tailor-made irons. But beyond these moments, Reebok's struggles continued. Hainer revealed to investors the true scope of what they had accomplished to reinvent Reebok over the years. In 2007, they had fired the entire leadership team, overhauled the brand's supply chain, and stopped supplying products to retailers. In 2008, they had updated Reebok's logos, slogans, marketing, and messaging to be a fitness brand that quote-unquote fits everyone. Now in 2009, Reebok was finally launching products that reinforced their new positioning, like the Smooth Fit Select Ride, a running shoe that could turn into a training shoe with the push of a button, zigzag shoes with zigzag soles that propelled the wearer further with each step, and easy tone technology to help women tone their legs and butts. Hainer had more to show investors in 2009 beyond new products and timelines. He was so committed to Reebok's success that he put the Adidas company through a massive reorg to consolidate both brands under one single operating model. The idea here was to maximize synergies and efficiency, so Reebok would sell and distribute into Adidas's international channels, and Adidas would do the same with Reebok's US channels. Under this single model, everything would be shared. To facilitate this, Hainer created a new company structure, a global sales organization dedicated to selling, and a global brands organization dedicated to marketing. All departments across Reebok and Adidas would roll up into one of these two organizations. This reorg was one of the more controversial moves of the Hainer era. Historically, Reebok and Adidas had operated independently and for good reason. While a single operating model enables efficiency, eliminates miscommunication, and reduces duplication, it also reduces autonomy and speed as employees now have to consider both brands in their day-to-day work. The other issue is the apples-to-apples oversimplification, as this operating model assumes that what works for one brand will work for the other. Beyond Reebok and the reorganization, Hainer made what may have been his biggest mistake as CEO in 2009 when he opted to double down on retail. Contrary to Nike, Hainer believed future profits to be in retail and not e-commerce. There were 2,200 Adidas and Reebok stores around the world at the time, and Hainer wanted more, better, and faster. His vision was for Adidas to become a leader in retail where anyone could walk into an Adidas or Reebok store, request a product, and get it delivered to the store within a few days if it wasn't in stock. In order to achieve this speed at scale, operation teams were now told to streamline and harmonize retail operations and supply chains. Hainer also created a new department dedicated exclusively to retail. He pitched that the consolidated single operating model, combined with stronger retail presence, would be the missing ingredient to achieving the net income and operating margin that he promised 4 years ago. Hainer could not have picked a worse time to double down on retail. 2009 was the inflection point in which e-commerce surpassed department store sales. Hainer's decision to go even more all-in on retail that year would not only cost Adidas hundreds and millions of euros, but also leave e-commerce open for Nike to take over, a decision that Adidas would regret to this day to the tune of billions of euros every year. In a normal year, there likely would have been more scrutiny of Hainer's performance in 2009, but ultimately investors were too preoccupied with the global recession to make a fuss about Adidas. The next year, in 2010, Adidas's revenue surged 15% thanks to the World Cup. But the company had still failed to achieve the top line or bottom line that Hainer had promised 5 years ago. Operating margin and net income sat at 7%, below the double digits that were committed to shareholders. Between 2005 and 2010, revenue grew on average at 4.7%, well below the double digits that were promised. On a per-brand basis, Reebok's annual sales had plummeted 22% from 2.4 billion euros in 2006 to 1.9 billion euros in 2010. In the same time frame, Adidas sales had grown 32% from 6.6 billion euros to 9 billion euros. But most worrying of all was that North American sales across both brands had dropped 15% from 3 billion euros to 2.7 billion euros in the same time frame. Adidas was going backwards in its most crucial market. To his credit, Hainer nailed basketball in the international segments of his strategy. Sales in Asia grew 42% from 2006 to 2010 from 2 to 3 billion euros. Sales in Europe grew 20%, while Latin America sales skyrocketed 165% in those 4 years. Shareholders were disappointed with the failure of Hainer's 5-year strategy, but they weren't actively calling for his head. Perhaps it was the international success or the recession serving as a timely distraction, but Hainer continued onwards. He rolled out a new long-term strategy that he called Route 2015, a 5-year roadmap with the goals of reaching 17 billion euros in annual sales and 11% operating margin by 2015. In his Route 2015 presentation, Hainer proclaimed that Reebok's reinvention was finally complete. Adidas would now dedicate itself in the next 5 years to pushing Reebok to market and establishing its new positioning as a fitness brand. Hainer stuck to his multi-brand portfolio approach, but this time he visualized it on a spectrum. He separated the Adidas brand into two. On one end, there was Adidas Sports as the performance brand for competitive athletes. On the other end, he had Adidas Originals as a lifestyle fashion brand for everyday consumers. Hainer placed Reebok in the center of the spectrum as the casual fitness medium between both extremes. Under Route 2015, Adidas would specifically attack 3 markets: North America, China, and Russia. Hainer designated these 3 markets as must-win battlegrounds for Adidas in the next 5 years. Winning these 3 markets, he believed, would unlock 50% growth. For North America, Hainer felt that besides basketball, there wasn't much value in professional American sports. Reebok's existing deals with the NFL, MLB, and NHL didn't match its new positioning as a casual fitness brand. In 2010, Reebok signaled that they wouldn't be renewing their NFL and MLB deals and routed those cost savings to sign a deal with CrossFit, which had hit mainstream popularity. Hainer was convinced that running, fitness, and basketball would be enough to win the American market. His decision to give up on the NFL and MLB in exchange for CrossFit would be a major mistake that Nike happily capitalized on. Nike was popular in college football thanks to its bold, pro-combat uniforms and flashy team sponsorships. Applying that playbook and built up goodwill to the NFL was a cakewalk billion-dollar move for Nike. To solve for Adidas and Reebok both failing to sell in North America, Hainer switched the target audience. Under Route 2015, the company would prioritize marketing to American high schoolers rather than adults for the next 5 years. Hainer felt that Nike was too entrenched in adults and high schoolers were more viable as the next generation of shoppers. But to go from sponsoring the Super Bowl to back-to-school campaigns and school lockers is certainly one of the bigger head-scratching decisions of the Hainer era. Meanwhile, Adidas was doing well in China but starting to see increasing competition. In Russia, Adidas enjoyed 60% market share, but Hainer wanted more. He wanted complete market penetration, ordering further investment in Russia for the next 5 years. Hainer strangely seemed to have forgotten about being burned by the Russian ruble depreciation just a year ago. And once again, retail was at the core of Hainer's new strategy. In his presentation, he preached the importance of winning the customer at the physical point of sale, believing that retail would continue growing double digits every year. More stores, higher productivity, better store experiences, greater presence at malls, and faster shipping to stores. In Hainer's 35 slides of Route 2015, there was not a single mention of e-commerce. In its first year, Route 2015 was a success. In 2011, net sales in North America grew 12%, Russia was up 26%, and Asia grew 15%. Hainer's bet on retail was validated as comparable store sales grew 14%. Both brands grew at record levels in North America, with Adidas sales up 21% and Reebok over 20%. The market seemed to react positively to Reebok's new fitness positioning and products. Vindicated by these early returns, Hainer used this momentum to expand Adidas's ambitions. Seeing the success of North Face and Patagonia, Hainer bought the emerging brand 510 for $25 million to enter the outdoor performance market. The following year, 2012, was another strong year for Adidas. Thanks to the London Olympics, the company grossed a record 14.9 billion euros with 11% growth. Operating margin improved from 7% to 8% year over year. This would have been a perfect year had it not been for Reebok. Just when the company thought that they were home free, they found the final skeleton in Reebok's closet. During a routine audit, Adidas discovered irregularities in Reebok's India business. Upon investigation, they uncovered a criminal operation where Reebok management had colluded with local partners to inflate the region's sales and profits. It was more than just overstating revenue. Management intentionally didn't record customer returns, they skimmed money from accounts receivable, and they operated 4 hidden warehouses of stolen product. This had been going on for years, meaning nearly all of Reebok's numbers had been misreported. 7 years after the acquisition, Adidas was still paying the price for Reebok's mismanagement. As embarrassing as the scandal was, Reebok's business was far more alarming. The brand's success in 2011 turned out to be nothing more than a flash in a pan or a one-year wonder. Reebok's sales declined 17% in 2012 after being up 20% the year before. Heiner's spin to investors was to look on the bright side that the brand was now stabilizing, but it was clear that nothing was working. The marketing wasn't sticking, CrossFit wasn't increasing desirability, the brand was unreliable, and the sales were simply too inconsistent. 2012 would be the beginning of the end for Heiner. In 2013, investors were eager to see how Adidas would perform in a year with no major sporting events, no Olympics, and no international soccer tournaments to boost their sales. Heiner put the company through another reorg that year, merging the retail, wholesale, and e-commerce teams within the global sales organization. Historically, these teams had been operating as independent silos, but Heiner now wanted an integrated omni-channel approach. On the R&D side, Adidas continued to make progress on running technologies with the launch of the Boost shoe. Reebok continued to flatline despite the company's best efforts. Adidas came up with a new target customer for Reebok that they called quote-unquote the fit generation, which it defined as consumers young in age or spirit who enjoyed getting fit and staying fit with friends. Needless to say, this generic persona failed to land in the market. Reebok also expanded its sponsorship to the trendy Spartan race, but the company seemed to have misinterpreted that for most participants, the Spartan race was more about the social media photo op than about the running itself. Overall revenue declined 3% that year to 14 billion euros. Sales in North America fell 1%, while Asia and Europe dropped 5%. Reebok sales continued to freefall, decreasing 4% year over year. As a company, Adidas was getting further away and not closer to its 5-year goals. Investors were losing patience. Feeling the heat, Heiner even began to publicly question his own strategy, acknowledging that perhaps he had been overly ambitious when he set those goals back in 2010. Behind closed doors, Heiner acknowledged to Adidas' biggest investors that the company was not where they needed to be, or thought that they would be 3 years into Route 2015. While he admitted that Adidas had made quote-unquote a few mistakes, he pointed the finger at world events that happened beyond the company's control. Raw material costs, unfavorable currency movements, the Boston Marathon bombing, Tyson Gay's suspension, Derrick Rose's season-ending injury, and RG3's career-ending injury were all specifically brought up by Heiner as unlucky incidents that hurt Adidas' sales. When the meeting came to a close, Heiner tried to restore confidence in investors, but what he intended to be an inspiring closing instead came off as an unhinged rant. Who else in the industry could do what Adidas is trying to do, he challenged investors. Quote, who in our industry has the insight and know-how to unleash game-changing multi-billion long-term platforms like Boost, Clima, and MeCoach? Who in our industry has the imagination and creativity to open up the wardrobe of the sports consumer, building not just one, but 3 highly diverse, authentic, inclusive brands? Who in our industry has had the foresight to embrace the world of fitness? It was likely this moment in which investors lost what little remaining confidence they had in Heiner. At the time, Nike had Jordans, Air Forces, Air Maxes, Converse, Jack Purcell, and Nike Plus. For Heiner to pound his chest and declare that no one else in the industry had anything close to what Adidas had in brands, products, and expertise is a delusional thing to say. In 2014, Adidas' struggles continued. Despite the Brazil World Cup and sponsoring Pharrell fresh off his Happy single, the company surprisingly regressed in revenue and profits. Revenue grew at less than 1%. Operating profit fell from 9% to 7% year over year. Adidas was not only entirely off track from its 5-year goals, it had also missed its own sales guidance for the year. Heiner's 5-year commitment to reaching complete market penetration in Russia significantly increased the company's exposure in that market, and now those chickens had come home to roost. In 2014, the price of oil fell and took with it the Russian ruble. The currency cratered, triggering a global sell-off of Russian assets, which was worsened by the international sanctions that had been placed on the country for Putin's annexation of Crimea. While the 2009 ruble depreciation had cost Adidas 200 million euros, the 2014 Russian financial crisis burned the company over double that amount, wiping out 550 million euros in net sales. Heiner had lost faith in Reebok's leaders and replaced the entire executive team once more in 2014. This time, he picked a man by the name of Mark King to revive the American brand. Mark King lasted 4 years at Reebok before becoming the current CEO of Taco Bell. Mark King at Taco Bell has been widely criticized and deeply unpopular with consumers for discontinuing menu favorites like potatoes, Mexican pizzas, triple-layer nachos, and the 7-layer burrito in the name of cost-cutting. That should tell you everything you need to know about Mark King as an executive, Heiner as the CEO who appointed him, and the dysfunctional state of Adidas and Reebok at the time. Investors were furious and wanted Heiner out. There were no words that could restore their faith in the CEO after 2014's disastrous results. Heiner had failed to execute, grow revenue, or optimize the bottom line in the 13 years that he had been in charge. In the past decade, he had bounced from one failing 5-year strategy to another. Adidas had lost ground to Nike and at this point was even losing to Under Armour in the United States. As much as investors wanted to blame all the shortcomings on Reebok for dragging the company down, the reality was that both brands were underperforming. Incredibly, Adidas's board renewed Heiner's contract for 2 more years. Investors were outraged as to why an underperforming, directionless 13-year CEO should be rewarded with higher pay, longer tenure, and greater job security for progressively worse results. Investors went on the offensive, publicly questioning Heiner's leadership, calling out the mismanagement of Adidas, and threatening a hostile takeover if a new CEO was not appointed. In early 2015, Heiner invited investors to Germany to a 2-day event at headquarters, complete with 5-star hotels, drinks, and private transportation. To an audience of his harshest critics, he revealed his new 5-year strategy called Create the New in a final attempt to keep his job. With Create the New, Heiner promised high single-digit sales growth every year until 2020, 15% increase in net income every year, and a 30 to 50% dividend payout. Heiner admitted that under his watch, Adidas had lost touch with consumers. The decision to consolidate Reebok and Adidas under one single operating model back in 2009 had hurt the company's ability to be agile. Products took too long to reach the market, while design and production were too slow and inflexible to adjust to emerging consumer trends. This new 5-year strategy was based on 3 pillars: cities, speed, and open source. Instead of prioritizing growth of individual countries like Russia or China in the past, Adidas would laser focus on 6 key cities: Los Angeles, New York, London, Paris, Shanghai, and Tokyo. These cities were chosen as high-profile international destinations that are trendsetters in fashion. Consumers in neighboring areas, countries, and regions often take inspiration from the celebrities and influencers who live in these 6 cities to determine what outfits or shoes to buy and wear. Global brands, Heiner believed, were created in global cities. As an example, if Adidas could win running in New York and Los Angeles, then the company would win running in the US as a whole. Adidas would now overproportionally invest in marketing and influencers in these 6 cities every year for the next 5 years to restore its relevance and consumer appeal. To support this new localized focus, Heiner reversed the company's single operating model where everyone was forced to standardize behind one global message every year and moved back to the original decentralized siloed approach where each group ran its own marketing. Each division, from running shoes to Adidas Originals, would now have the creative freedom, messaging, campaigns, and budget. This was another case of where Heiner's push to consolidate and centralize everything in 2009 had backfired. The next pillar was speed. Heiner targeted e-commerce as the next highest priority with the goal of achieving 2 billion euros by 2020. To put into perspective just how behind Adidas was in the world of e-commerce, Nike had already achieved Adidas's 5-year sales goal at the time of Heiner's presentation. Nike had surpassed 2 billion euros in online sales in 2016, 4 years ahead of Adidas's. Nike's own 5-year goal was to surpass 12 billion euros by 2020. That's how underinvested e-commerce had been under the Heiner era. In addition, Hainer demanded an evolution of Adidas's design and manufacturing processes in order to reduce production times, improve the time to market, enable customization, and to launch more in-season products. The last pillar was open source. To Hainer, Adidas's traditional, in-house, meticulous product design worked well for its performance products, where professional athletes obsessed over every single detail and only rotated their wear once a year. But in the world of consumer footwear, this old-school approach was too slow to keep up with consumers, and the in-house designers lacked the creativity and star powers to become trendsetters. To win consumers, particularly those in the big cities, Hainer mandated collaboration with influencers like Kanye West and Stella McCartney to bring a fresh, unconventional look to the overly traditional German brand. While Hainer's 3 pillars were solid, his 5-year strategy for winning back North America was uninspiring and puzzling. The new goal would be for Adidas to increase its visibility on the field through heavy grassroots marketing in American football, lacrosse, baseball, and volleyball. High school locker rooms were the battlegrounds that the company wanted to win in. This was yet another case of Hainer going in circles, attempting to fix mistakes 4 years too late. If the goal was visibility, then he shouldn't have given up the NFL and MLB to his biggest competitors. In potentially one of the best examples of modern sunk cost fallacy, Hainer continued to maintain his loyalty to Reebok. To quote, "Reebok is one of our 3 main brands. We have been hammered for 7 years about it, but we have turned the brand around. We would be stupid to sell it now." While there was merit and evidence that Hainer had learned from his past mistakes in this new 5-year strategy, investors were not convinced that he was still the right leader. Their offensive continued, and the public attacks kept coming. To quote, "Adidas responds to market conditions, but it seems to have forgotten how to set trends itself. Where are the product innovations with which you want to take market share from Nike and Under Armour? A new strategy would only be believable with new leadership." Adidas is panting behind the competition. It's lost the race, at least in 2014. Nike is pulling ahead, and against this background, it's incomprehensible why the board extended Hainer's contract by 2 additional years. It wasn't just shareholders who were souring on Adidas, it was also the wholesalers and retailers who had noticed the company's declining appeal. Under Hainer, Adidas had lost ground to its biggest rival and even newcomers. Retailers would now rather stock Nike, New Balance, Lululemon, and even Under Armour over Adidas and Reebok, all of which was having a material negative impact on the business. Even in areas of strength like football, Nike was also catching up, with its sponsorship of Barcelona, Neymar, and an exclusive Cristiano Ronaldo boot collection. The public criticism of Hainer from hedge funds and large investors was simply too overwhelming to ignore. While Adidas initially hired investors and advisors preparing for a bitter fight, the board quickly backed down and gave in to investor demands. Shortly after Hainer's new strategy presentation, Adidas kicked off a CEO search and settled with Hainer to take an early retirement once the new leader was appointed. 2015 turned out to be the most successful and pivotal year in Adidas's history, but for Hainer, it was too little too late. As a CEO, Hainer had his flaws. He was too reactionary, too stubborn about sunk costs, too loose with M&A, stifled creativity in favor of efficiency, underinvested in e-commerce, and made too many bets that backfired like Russia, retail, and Reebok. But there was a lot of good that Hainer did in his last year that would revolutionize Adidas forever. Hainer's 9-year strategic focus on running finally bore fruit in the launch of Adidas's best product ever, albeit not exactly in the way he had intended. In 2015, Adidas launched Ultraboost, and the shoe became a global fashion phenomenon, widely praised and sought after for its unique blend of high-performance running, comfort, and fashion. The iconic silhouette of the Ultraboost, the prime knit upper, the separated lace cage, and the boost cushioning technology had culminated from the 9 years of continuous R&D that Hainer had initiated back in 2006. In 2015, Adidas also launched NMD as a new lifestyle sneaker with performance elements of Ultraboost. Yet the biggest launch in 2015 was neither Ultraboost or NMD. Instead, it was Kanye West with the highly anticipated release of the Yeezy Boost 350s and the Yeezy Boost 750s. Sneakerheads and Kanye fans waited hours in line from London to Chicago for these $200 sneakers, which were sold out online and in stores within the first hour. Fueled by the Ultraboost, NMD, and Yeezy 350s, Adidas skyrocketed to the top in 2015 with 16% growth in overall revenue, going from 14 billion euros to nearly 17 billion euros in the span of a year. Consumers fell in love with Adidas, making it the most popular brand on Instagram that year, and retailers took note of the company's new appeal, opening up significant shelf space and purchasing record-level quantities of Adidas products for their stores. Adidas's 2015 performance was a picture-perfect example of a successful comeback in sports. It's easy to say that Kanye West single-handedly saved Adidas with Yeezy, but it was an intentional decision by Hainer as CEO to give the musician the creative freedom, autonomy, and resources to create whatever it is that he wanted. That level of partnership and collaboration was something that not even Nike had been willing to do. Looking back, if we imagine a world where Hainer had made the right decisions as CEO, Adidas's already extraordinary 2015 could truly have been historic. If the company had kept its NFL and MLB deals, invested in their e-commerce business to just be on par with Nike, and had launched Ultra Boost, NMD, and Yeezy, Adidas might have truly eclipsed Nike that year. As poor as Hainer was as CEO, there's no denying that he was handing off Adidas to the next CEO in its best possible shape. A company that was struggling 1 year ago to be cool and relevant now had 3 new best-selling mainstream franchises and incredible momentum. Kasper Rorsted was appointed as the new CEO of Adidas in 2016. Rorsted was a proven CEO who was best known for his tight control over costs, his ruthless focus, and restoring profits at his prior company Henkel, a Germany-based multinational consumer goods company. In 2016, the first year of the Rorsted era, Adidas achieved a record revenue of 19 billion euros, growing 14%. Rorsted, true to his reputation, aggressively sold off what he deemed to be wasteful businesses in the TaylorMade golf brand and the Canadian CCM hockey brand. In contrast, Hainer had kept those underperforming brands around for years in the name of diversification. There was also a strategic shift in marketing with the new CEO. In Hainer's last year, Adidas had outbid Nike and its competitors to become the exclusive kit sponsor of Manchester United in a landmark deal. Under the agreement, Adidas would pay the English football club £75 million every year for the next 10 years for the right to produce jerseys. While Hainer saw this as a necessary expense to maintain relevance, Rorsted saw these tit-for-tat deals like this to be wasteful and bring little strategic value. Rorsted recognized that grassroots marketing and social media were making a greater influence on the modern consumer than these high-profile, expensive sponsorships and cold outbound media advertisements. Adidas decreased its sponsorship budget, gave up the NBA deal, and routed those cost savings into funding limited-time collaborations with creators and inventing new shoe franchises. Rorsted was brutally upfront about where Reebok stood in his eyes. The brand had zero growth in North America, its home market, for several years, and its margins were significantly below the company average. Growth was a lost cause, and tweaking messaging and positioning at this point would be pointless. The best Reebok could now aim for was just to restore its profitability. Rorsted rolled out a cost-cutting plan for the American brand that he titled Muscle Up, which included shuttering 50% Reebok stores across 3 years. Meanwhile, the momentum continued for NMD, Yeezy, and Ultra Boost, with new colorways and models that continued to dazzle consumers and sneakerheads around the world. Adidas continued to reach new heights in 2017, growing 7% in overall revenue from 19 billion euros to 21 billion euros. New Ultra Boost, NMD, and Yeezy shoes accounted for 77% of Adidas brand sales, yet Rorsted noticed that the longer the models lasted on the market, the faster the price dropped and the lower their margins became. To counter this, the company proactively expanded its creator network, launching limited collections with people like Alexander Wang. Rorsted saw these one-time collaborations as invaluable to maintaining both profits and relevance. By launching new models, collections, and also limiting the quantity available every season, Adidas could maintain its gross margins and extend the lifespan of Ultra Boost, NMD, and Yeezy franchises through scarcity. Having a large pipeline of new in-season products, especially when it came to shoes, became critical to Adidas's success. Rorsted adjusted R&D to support this new luxury approach, replacing the traditional development of products in advance of high seasons with in-season production and rapid replenishment manufacturing. By 2017, the majority of Ultra Boost and NMD shoes had been manufactured with a lead time of 60 days or less. With greater desirability, luxury positioning, and intentional scarcity comes greater pricing power. Adidas began shifting its business towards its full-price premium products and started issuing fewer discounts to retailers who had no choice but to accept the terms. Meanwhile, North America was surging. The company's sales in the region were growing 25% every year for the past 3 years, going from 2 billion euros in 2014 to 4 billion euros in 2017. From 2018 to 2019, Adidas enjoyed stellar years, achieving for the first time in company history 9% growth and double-digit operating margins back-to-back. Investors were delighted as Rorsted delivered the top line and bottom line that Hainer could not. Yeezy became a forcing function and driver for Adidas's e-commerce business as the company began doing digital drops of its most coveted products like the Yeezy Boost 350 V2 Triple Whites. Ultra Boost continued to flourish, releasing the widely praised Ultra Boost 4.0, which many consider to this day to be the franchise's best model, alongside a limited edition Game of Thrones collection during the show's peak. Adidas formally entered the high-end outdoor market with its My Shelter line to compete with Patagonia, Arc'teryx, and North Face. To this day, Adidas's success continues, but there are signs of staleness. By a function of age, Ultra Boost and NMD have lost some of their shine among sneakerheads and consumers. While Reebok continued to make progress on its margins, Rorsted had seen it enough and eventually sold off the brand at a loss for $2.5 billion in 2021 to a fashion brand conglomerate. Having finally shed Hainer's 15-year mistake, Rorsted's new company vision is a single brand focus on Adidas, with a greater emphasis on e-commerce and international growth. They've added 6 more key cities to win in Mexico City, Berlin, Moscow, Dubai, Beijing, and Seoul. While the future remains bright for Adidas, there are new questions and challenges emerging. Can Ultra Boost last another 5 to 10 years? Will Adidas still be the one to invent the next fashionable shoe franchise? How far will Yeezy's innovation and eye-catching designs carry the company in the future? Rorsted has proven himself to be a very strong operator, but the company at this point looks like it needs a visionary. Is he good enough to chart a path forward? And how much of Adidas's success today should be credited to Rorsted when he inherited Kanye West and Ultra Boost, creative bets that were made by his predecessor, Hainer?